Right, good afternoon, Finom Group members. So we've kind of decided to start recapping our weekend research report because we have a lot of members that I'm sure find it difficult to study the weekend research report, take notes, concentrate on it, especially during football season, right? So we're going to try to do this weekly video. Can't make any promises. It'll be every week, but on Mondays we'll try to, kind of go over the weekend report or some of the finer points within the weekend report. Maybe answer some questions here live in the trading room to give more context. And again, as a time saver for some folks that just can't dedicate, the possibly hour that it might take to go through every aspect of the weekend research report. So here we are. September seasonality sucks, but there's more to consider. That was the title of this weekend's research report. And again, you can see how extensive it is. We go through a number of different topics, whether it's technicals, fundamentals, anecdotes, technical update, as you could see there. Wrap it all up, but you see I'm still scrolling. There are a lot of charts. There's a lot of economic data. You name it. It is all inside here. And if you're not a Finom Group member, not subscribed to our contributor membership program or our premium program, folks, this will get you done. We combine a lot of different services and data and analytics from third party right here, from third party research right here, along with our proprietary data analysis, etc., in the weekend research report. So without any further ado, we kind of kick things off this weekend with an understanding of where investor sentiment was. Here's the latest from the AAII bull bear sentiment. And as you can see, it's bullish sentiment was only 18%. This comes out every Thursday morning. It's like 6 or 7 a.m. Eastern time. And, it's a survey of mostly retail investors, mostly boomers, baby boomers. But the bearish sentiment is elevated. And you can see the stair step down and the stair step up in the bearish sentiment here. Historically, a reading below 20 is what we deem, so far as bullish sentiment, is what is deemed to be extremely low bullish sentiment. Here are the historical average, 38%, like we're 20 percentage points below the historical average. And so far as the bearish sentiment, the historical average is 30%. We're at 50, we're 23 percentage points above the historical average. It tells you how bearish it is out there amongst investors. Don't take this to mean necessarily that people are positioned in accordance with their sentiment. That's not always the case. It's not a good positioning indicator. In this particular environment, it has been, but that's not the case always. So sentiment stinks. 2 weeks ago, because we do have a week off when it comes to our weekly research report cycle, 2 weeks ago in our previous August 28th report, we looked at this chart and it was not favorable. As you can see, this is the S&P 500. And from the beginning of the year, right? And then we have a beautiful rally, we have another beautiful rally, but we keep hitting this trend line of resistance. This most recent rally got us up the 200-day moving average. And then that's where we found firm resistance and trended back lower. And this happened on a Friday. I mean, this was the week to end Friday. It was that Friday at Jackson Hole speech by Jerome Powell, that we saw this, really big decline on that Friday. I think it was almost a 3%. And so you see a chart like this, you've left, the weekend, you've gone into the weekend with a really poor Friday performance, and this was everybody's focus, suggesting that there's the possibility that the low retest would happen in the interim. Suggesting, not guaranteeing or anything like that, but all right, so if we dive down a little bit further, the technicals are not definitive. And they never are. They never are, right? And what I mean by that, by and large, is the technicals have always told us. Okay, it looks like we got disconnected there for a second. So as I was saying, we'll get into the technical portion of this weekend's research report. Title is the technicals are not definitive. They never are. Technicals tell us what happened, what's developing, and then it's up to us, right? What, based on our experience and pattern recognition, understanding of resistance levels, support levels, the various different stochastics like RSI, what are they telling us may occur in the future? So technicals are never definitive. They're part of your building blocks in your research process, your due diligence. They're building blocks. The more and more you're exposed to the different or various forms of analysis, fundamental analysis, technical analysis, or disciplines is how I prefer to think of them, technical, fundamental, and quantitative disciplines, the more you expose yourself to them, the more reliable your predictions or outlook will be. So this was a note that we had actually issued several weeks ago in another, often we will link to previous reports, but this one was in the August 28th report. We talked about there was this big breath thrust here on July 19th, and you can see it in the size and scope of the candle here. So we broke it down into candles as opposed to lines, because we wanted to recognize that there was a big gap open there and there was a big breath thrust. It's just easier to see in this form, candlesticks as opposed to a histogram or a solid line. And what we recognized is, look, more often than not, markets like to mean revert to a certain degree. They like to revisit the scene of the crime in terms of finding durable support before the next potential leg higher. And what we also know is that like 85–90% of gaps get filled at the index level. Heck, 100% of gaps for the VIX have been filled historically. So there's a good probability, in terms of finding durable support as we started to come under pressure. Once we hit the peak in August, we started to come under pressure. We're looking for support levels. We're looking for gaps to the downside that might get filled. And this was one that we articulated in our research report we should be aware of. And it comes in at this 39.36 level, 39.36. So it was an area that we were highlighting and discussing throughout the week. Lo and behold, what happened? We came all the way back down to this level. We tried to hold support at 3,900 for a day. We did. We broke below it another day to make a 38.86 low on an intraday basis, but rallied back above and pretty much held this area of support. We can't, suggest that this is the ultimate support and we're just going to go higher from here, any more than we can suggest it won't come back down to this 39.36 area and possibly break below. What we do know is that it has held so far. And what I'm thinking is that when you do find a key level, a key gap that gets filled, and then you bounce back to the upside, usually that is a sign of durable support. And you need something on the macro fundamental side of the equation to go wrong and invalidate this support level. Hasn't happened yet. We've got a lot of key economic data out this week to consider, of course. So let's move on. We've talked a whole lot about, well, when we do get these consolidation periods, we're often, unfortunately, a lot of folks are looking at their most trusted Twitter follows. They're listening to CNBC or Bloomberg or Yahoo Finance. They pay too much attention to the hyperbole in and financial news network flow, as opposed to, trusting in their research, as opposed to trusting in the data, right? They get glued and they want to know, is this something I should be worried about? Is this time different? Will support not hold? Will the breath thrust that happened from July into August be nullified? Is this time different? Or is this just more of the to be expected consolidation? And in that respect, we refer to one of the breath thrusts that happened in the July to August period, which was 90% of stocks getting above their 50-day moving average, went over the maximum drawdowns. And what we found is, going back to 1947, when you had that breath thrust, that many stocks going above their 50-day moving average, the max drawdown ever over a 1-year period was 11%, had one for 7%. And here are the averages of that. And this comes from Chris Shavako's study. And what we outline to our members is, indeed, if this is the worst case scenario, we need to know from the peak in the rally, which was 43.05 on a closing basis, and 43.25 intraday, but we use closing basis. And I'm not dealing with decimal points here. Give me the 11%, I'll be happy. So from that 43.05 closing, if we repeat the worst drawdown at 11%, that would basically take us to 38.32. Again, it's just about being open-minded to the possibilities, being able to put this into your game plan so far as where you might buy the dip, and how you can determine if this is normal and to be expected. If it's happened in the past, it can happen again, and that would be normal and to be expected. It wouldn't be an anomaly. If we went down 12, 13%, then that would be an anomaly. It's not normal to expect 12, 13, 14%, because it's never happened before after firing this kind of a breath thrust. So as of this point, we got as low as 38.86. We've bounced above 4,000. Today, we bounced above 4,100. I don't know where we'll close, but that's where we bounced above here today. So far, normal and to be expected based on everything that we've outlined in past weekend research reports. Nothing to be afraid of. Everything to have taken advantage of. And that's the reason why we have this data. That's the reason why you read weekend research reports and watch state of the market videos that we issue every Thursday. It's to know whether or not you should be afraid. So far, nothing to be afraid of. I talked about this guy who asked me, can you please elaborate? What are the things that will make you a bear? My bottom line is, why would I want to be a bear? The market goes higher over time. When the market corrects, I get value. There's nothing wrong with value. It's opportunity for the long run. There's no such thing as a bad market. That's how I operate. I always have. Well, I shouldn't say always. That's a little bit disingenuous. As I've gained more and more experience over the years, I've learned how to manage my cash through different market environments. And when I do have a discount, when there is value offered to me, a correction of 10%, 15%, 20%, whatever, I can still deploy capital based on all the other research that I've done that tells me take advantage of the value. It's about a mindset. This guy, he's just always worried about the downside. If you're always worried about down, you're never going to benefit from up. I've never met a fund manager. I've never met an independent portfolio manager. I've never met a single trader that is constantly worried about the downside, constantly hedging downside risk, but benefits to the degree the market performs to the upside, let alone outperforms. It doesn't work. It just doesn't work. That's not me saying don't practice risk management. You should practice risk management. But if you find yourself, where you're constantly managing anxiety, this is not for you. And this is not for him either. It doesn't stop. I think I can show you today because he came back. Again, this is, we're just doing this in real time. This is what we do every day in the trading room. We watch videos, we go over data, so on and so forth. What am I doing? Tweets and replies. Yes, that's correct. Tweets and replies. So he had a response to me overnight here, and I responded in kind. And this is the way I would suggest you respond to these folks who are constantly with this mindset of down is forever, basically. It's a down forever concept. Maybe he blocked me. I don't know. I could have sworn it was this morning. It was early, so let's see. Well, he might have blocked me, folks. Because basically what I told him is, I've got to disengage from you. I can't entertain your consistent bearishness, your consistent pessimism, your consistent, blah, blah, blah. Like, if that's your purview, that's your approach to the market, I'm of no help. I'm of no help. Nothing I say. Here we are. Okay. So, all right. I said, why would I want to be a bear? I mean, you saw the response in the weekend report. So is it accurate to say you're a permabull? As if this is a bad thing, by the way. It's a bad thing to be the permabull. Which way does the market go over time? It goes up. In a downtrending market, you get value. In an uptrending market, you get the profits from taking advantage of that value. You should be a permabull. Or am I missing something? Please take a look at real terms is what matters. No, real terms don't matter. You know why? You can't do anything about it. These people that talk about inflation adjusted, right? That's the real return of the S&P 500, inflation adjusted. There's nothing practical about this. You don't know in real time what the inflation adjusted return is going to be. It means nothing. It's the same thing as when people say, well, what are the inflation adjusted retail sales? Who cares? $1 through the economy is $1 through the economy. You can't do anything about it. It's that kind of nonsense. He's looking for a problem. He's not looking for one for me. This is not a problem for me. I can't do anything with this. I know that a long time ago. It doesn't change my investing style. It doesn't change my discipline. This is the kind of stuff that, just folks that are looking for every excuse not to leverage into value opportunities. By the way, I'm not saying I'm a bear. You don't need to tell me one way or the other. I don't care. You're your problem. Seasonality and midterm elections are usually good for equities. Inflation leading indicators are pointing to continued moderation. I'm just saying that if I estimate that a lost decade, and this is the other thing, because that's what people like, he's looking at a lost decade, like right here, right where the S&P 500 goes nowhere. That doesn't mean you were all in here. Boom. It just means it took like a decade for the S&P 500 to come back. But let's say you bought down here. Do you need the S&P 500 to get all the way back there? No. Let's say, oh, well, I got screwed there and it went back down. Okay, I still have cash on the sidelines. I'm still saving to put, to invest money in my 401k, and I bought here again. You're going to compound from here and here when it does get back. You don't need it to get back here. You might only need it to get here for your portfolio to break even. I can't explain that to somebody like this with the limited characters on Twitter, right? So I give up. I have to move on from engaging with you again. I just can't do that with these people, just continue to go back and forth over nonsense. At the end of the day, it is appropriate to be a permabull. Here's the pyramid chart from 1928 to 2020 of annual S&P 500 returns, blurry as it may be. You can see right here, Going back to 1928, positive returns were 73% of all years. If you include 2021, because this only came up to 2020, right? We know 2021 was a 26% S&P 500 return, if I'm not mistaken. Don't quote me. It's 24 or 26, inclusive of the dividend. Now you're up to 75% of all years. You only have a 25% chance of the S&P 500 historically delivering a negative return on any given year. Only a 25% chance. It's a very, very low probability. What's even lower? Back-to-back down years. Back-to-back. We haven't had a back-to-back down year since 2000, 2001, 2002, back-to-back-to-back. Before that, you had to go back to the 1940s. That's how rare that is. And you want to talk to me about a lost decade? Here's the other thing. These dates right in here, right, that makes up the largest part of this pyramid structure, as a glorified pyramid, as I might call it, is 10 to 20% return years. More often than not, the S&P 500 is delivering an annual return of 10 to 20%. How often is it delivering a 10 to 20% negative return? Actually, 1, 2, 3, 4, 5, 6, 7 years. Only 7 years, 10 to 20% in the red. More than that, 20 to 30%, only 3 times, twice 30 to 40, one of which being 2008, the other 1937. This is just the facts. And like, so when people are on, CNBC and Bloomberg are talking to you about this risk, that risk, do you not think that these risks have been around for decades upon decades upon decades? But look at what the market does anyway. It just sounds smart to be cautious. It sounds smart to talk about real returns, inflation adjusted. It sounds smart. It's of no practical use to you. That's just a fact. Options expiration week, we did some technical work on that for our weekly state of the market, so I won't bore you to tears here. Just revisiting that exact data. And again, this is seasonal stuff. And as I always say, when you get seasonal quantitative data, just like sentiment quantitative data, pair it with other data. Do not use that kind of data in a vacuum. Mondays of a monthly options expiration week, which is also an end of quarter, so it's a quad witching. Mondays, the average return has been negative. This goes back to 2010. There have been 50 occurrences since 2010, quad witching. Mondays have been negative. All right, let's see. Now I want to see where we are. Right? This is why I say don't use it by itself. Pair it with other data. And you got to know the trends going into this kind of week. 56% of the time, the market has been positive on that Monday, but the positive return has only been 0.6. The negative return has been double that, which is why the average return is negative. Tuesdays, pretty good. And the percent positivity rate increases from 56% to 64%. But most of, you can see, like Friday sucks. Options expiration day, which is Friday, that day has only been positive, very sparingly, 46% of the time. So the majority of time, the market is in the red on Friday of a quad witching week. We talked about the cycle composite index, so I don't want to bore people to tears. Let us talk about the S&P 500 technicals. So on Friday, we closed above the 50-day moving average, right? We recaptured that, reclaimed it. We also closed above the 100-day moving average. More than that, the 50-day moving average rose above the 100-day. You can't quite see it here, but it did indeed. The 50 rose above the 100. The 50 is not quite above the 200-day moving average at this point. And I can't, suggest that, that's something that's imminent. It's not. We're in a downtrend. The 200-day moving average is telling you that. It's sloped down. We tried to get above it here. We tried to close above it. We got rejected. So it's still downward sloping. And when you have a downward sloping moving average, especially the long-term 200-day, you are in a downtrend. It's part of the definition of a downtrend. The interim trend is up, as highlighted by a curling upward 50-day moving average. The RSI, 14-day RSI, finished the week at almost 51%. And that's kind of your Mendoza line, right? 50 and above is a bullish RSI. Below 50 is a bearish RSI. Another way we looked at it, because we're trying to find understanding of support levels, we looked at the Fibonacci retracement from the lows in June to the most recent high here. My internet is unstable. To the most recent high here in August. And indeed, the 618 level, the 618 Fibonacci retracement level, and we briefly broke below it, but then slingshot higher. Right, and the level came in at 39, looks like 39.06 at that time. So we found support. At this point, it looks durable. Remains to be seen if we can continue to hold above and even trend higher, possibly trend back to the most recent high. The good news about this most recent high, it was higher than the June highs. So we're no longer, or at least at this point, we have not made even lower lows. Right now, we're making higher lows. It is important to reflect on this particular chart of the S&P 500, the slopes in the moving averages. Why? Because of something that we know everybody, is talking about, right? Because you get a lot of attention. It's the squeaky wheel. 2022 is like the 2000.com period, or it's like the 2007, 2008 period, where, in the past we had failed at the 200-day or at the 50-day moving averages. So people hyperbolize these things. They love analogs, and they love to anchor their sentiment to the dot-com period or the great financial crisis period, I should say. Sorry. These are the 200-day moving averages. We hit resistance, back here in 2008. We did, and we failed. Here it is again in the dot-com period, hit the 200-day, and we failed. But I want to look at the 50-day, right? Because we need to understand how the indices reacted to the 50-day moving average, because that's easier to break above and elicit a false rally or a bear market rally, because it's a nearer term, it's a shorter duration moving average. It's an interim moving average. So here's the S&P 500 back in 2002 to 2003, right? Here we got above the 50, but we made lower lows in a seasonal period where the market tends to be weak. We did make lower lows. We were only briefly, maybe a week and a half above the 50-day moving average. It's important to denote, and what I'm highlighting here with the arrows is the slope of the 50-day moving average, right? So the fact that we didn't hold above the 50 with this kind of a slope in the 50-day moving average should have been no surprise. Should have been no surprise. We broke back above it, and now we're starting to curl higher, right? In the seasonally strong period of 2002, right? The fourth quarter usually delivers the best returns. They say the best time to own stocks, and it is historically proven, we have data, best time to own stocks, or the best 6 months of the year, November through April. The average percent positivity rate since 1950 is 78%. The average return is almost 8% over that time period. So we broke above and we stayed above the 50-day moving average here in 2002, late 2002, and we're curling higher in the 50-day moving average. Does that mean you're going straight up from there? Obviously not, because that's not what happened. But the fact that we did get that curling up and it stayed curling higher until, up into 2003 suggested all is not lost. Did we find additional consolidation? Absolutely. That's what this downturn once again is. But as most of you know, we made another, interim low, consolidation phase low in early 2003. And in March, that was it. We took off into the end of the year. Bombs over Baghdad in March, basically when we went to war with Iraq. Bombs over Baghdad, the market took off. The key here to understand is the slope. The slope means a lot. And so when we today look at the 50-day moving average, today it's sloped higher. It doesn't mean we can't consolidate, chop around, maybe even get down to 3,800. It's a matter of knowing what to do if that happens based on what's going on in the slope of the interim moving average there. Again, we have also crossed above the 100. Here's 2008. Is today like 2008, folks? Where do you see the slope of the 50-day moving average? The arrows are there telling you, right? So this is nothing like 2008. At no point did it reclaim for any more than a day the 50-day moving average. And through the entirety, basically from July on, it just kept falling. Not like today. This is today, folks. And again, these charts come from Chris Schiavocco. These particular charts here are from Chris Schiavocco. Whether we're looking at the individual indices or we're looking at performance ratios, we're looking at the ARK ETF. These are the 50-day moving averages of each of these indices and or stocks, ETFs, and performance ratios. The 50-day moving averages do not look problematic at all. It doesn't predict the future, right? As I always say, if you want something that rules all and can predict all, it's the macro fundamentals. They can overwhelm all of this technical stuff that we're talking about here. And that's often what it would take. And that's a key point. That's what it takes. It takes a schism in the macro fundamentals to overwhelm these technical formations. NASDAQ, same thing. Again, we're just looking, for some support levels, and wouldn't you know it, the 618 level, the Fibonacci retracement off of the June lows, also support for the NASDAQ. And the only reason why, I kind of included some additional context here for the NASDAQ was because right now, in terms of that 50-day moving average consideration, it has the fewest number of stocks trading above their 50-day moving average. This is the NASDAQ composite, right? The NASDAQ composite index, percent of stocks trading above their 50-day moving average, only 46. That means the majority of stocks are actually under their 50-day moving average, even though the index, just like the S&P 500, finished above its 50-day moving average. So either the NASDAQ has to catch up, it has to outperform, or the composition in the NASDAQ, because it is a growth index, right? I mean, if you think about the composite index itself, like 10 stocks make up almost 50% of the NASDAQ. 25 stocks make up 50% of the S&P 500. So the NASDAQ is very highly concentrated compared to the S&P 500. So we really need breadth to improve, to validate that the index is above its 50-day moving average. We want to see more than 50% of stocks above their 50-day moving average within the index. Here's a performance ratio, right? We looked at a couple performance ratios in here, but one that I'm keying off of because we think it is showing good value. If you want growth as well as value, as well as defense in your portfolio, I don't know that anything's going to do it better than healthcare. The healthcare, and you don't want to pick a healthcare stock, maybe that's not your thing, go with the ETF. Just a suggestion, not advice. And that's what I've done in the Golden Capital portfolio. That's what we're doing as, so far as Finom Group is concerned. And one of the things that we've looked at is this long-term uptrend, right? From the beginning of the year, even going back to 2021, December 2021, the healthcare sector ETF has by and large outperformed the SPY, or the S&P 500 index ETF. Right? So whenever the slope of the line is going up, healthcare is outperforming the S&P 500. When it's going down, as it has recently since peaking basically in July, it's been on a downtrend. But man, look at that. I mean, to the penny, as Carter Braxton Worth would say, found that support and has bounced significantly. Take a look at where it's trading today, actually. Here's the XLV. It's up another $1 here today. Not too bad. Look at the VIX, folks. It's making higher highs here today, regardless of what the indices are doing. Why? There's a lot of macro fundamental, highly potent and relevant data coming out throughout this week, right? We've got the CPI tomorrow on Tuesday, Consumer Price Index, probably the most highly anticipated reading of the year, even though we say that every single month, because that's how relevant it is to the whole Fed monetary policy regime. And then later this week, we've got, of course, jobless claims. We've got regional PMIs, purchasing manufacturer indexes. And we got retail sales on Thursday as well. So folks are hedging. Folks are hedging above and beyond the automatic hedging that takes place here on a Monday. Another performance ratio. Anyways, we think this is a, if you entered here, you entered perfectly, right? So far as the performance ratio is concerned, but the trend is your friend still. I mean, you've had bouts of consolidation here. You have a bigger one here, but it found support. We'll see what happens going forward. Again, if you're looking for both for defense, for value, and for growth, that's healthcare. All right, so this one is consumer discretionary, XLY, again, versus the S&P 500. And one of the reasons I've been following this one more closely over the last several weeks, right, because the market peaked out there in we'll call it mid-August, and we've been consolidating for the most part and ever since. But why has this performance ratio uptrended and stayed in its uptrend? This is consumer discretionary. This is not the stuff you need. This is not Clorox. This is not Pepsi. This is not your beverages. These are not your snacks. These are not your meals. That's consumer staples. That's the stuff you need, your food. This is consumer discretionary. This is stuff sold on Amazon. This is stuff sold at Target. This is stuff that's, this is your house stuff. This is, do I need another shirt? This is, these are not things, these are things you want. These are not things you need. And so if the market during this latest bout of consolidation, if it was happening because, well, investors are fearful that we're going into a recession when the Fed raises another 75 basis points, then why aren't they selling the consumer discretionary ETF and stocks to the same degree as the S&P 500 or greater than they're selling the S&P 500? It's because this is not what the average investor believes. They don't believe this consolidation phase is any more than a consolidation phase. It's not about the economy. If they thought it was, they would be selling consumer discretionary hand over fist. And it broke out. It's a minor breakout, but because this could be false, we don't know. It could be a false breakout, but on Friday's close, this was the breakout above these most recent resistance levels. Very nicely defined uptrend here. Not about the economy. Look at the RSI as well, 66, in danger of getting to overheated territory. Keep that in mind. If it gets to 70, that's usually the level that is considered overheated. All right, moving on. In financials, another relative performance ratio that we talked about And outlined here in the weekly research report is financials versus the S&P 500. And man, it's the exact opposite from what we looked at in the healthcare versus S&P 500 performance ratio, right? This has been in a consistent downtrend. It even made a recent low, right? Scary stuff. But man, the reflexive rebound off of that low has greatly outperformed the S&P 500. It's above both the 50-day moving average, and it actually had a closing value above the 200-day moving average one day last week before checking back. But man, that has flattened out. That 200-day, we're slightly curling up here on the 50-day. That's what you want to see. I think it's Mike Mayo at Bank of America, who is their strategist, who is pounding the table and financials, suggesting that their back half of the year, their results, their earnings results are going to be stronger than expected. Markets like to discount forward earnings. So that might be what's taking place here, and as you can see in the performance ratio. It had a very strong move off of this low back in May that failed mightily. So we can't take this for granted, but if we get another close above the 200-day moving average and an even greater curling up and possible curl higher in the 200-day moving average, you might do well either chasing the ETF a bit, giving yourself room if it does fall to the downside, or maybe a bank stock, a regional bank stock. KRE is another way to get this done. It's the regional bank ETF, ticker symbol KRE. Moving on, way to macro minutes. So we got the inflation data coming out this week. Really good highlights here from Bank of America Global Research that we included, and they're looking for a negative month over month print, and they're looking for the headline year over year number to come down, as well as core CPI year over year, 8.2%. They're looking for core CPI, which would be down versus the prior month, and 6% on the headline, which would be down. Let's see what else. ISM services, right? Because we had ISM manufacturing 2 weeks ago. Last week, we got to look at the ISM services, and possibly the more critical component within, whether it's the manufacturing indexes or the services indexes, are the new orders. And look at the jump in new orders from 59.9 to 61.8. That's an increase of almost two full percentage points there. The headline number, services PMI, edged up just a bit there, 0.2. Growing. The only thing slowing is what we want to, which is the supplier deliveries. All right, moving on. Let's see. Again, this is a calendar of economic data that we try to include in each weekend research report. Again, just trying to keep everything centered. You don't got to go anywhere else. It's all in the weekend research report. We get it done. Some more data here on median household savings and checking balances, right? Bank of America has the biggest client account numbers of any of the major banking institutions. They have more accounts than anybody. So if you're going to look for a national average, if you will, you go to the Bank of America data. And it shows the average checking and savings account is still, here's 2019. This is pre-pandemic. We are all the way up here, folks. As I've been pounding the table since the beginning of the year with all of these recession concerns, and market has much further downside to go because we're going to have a recession. I've been pounding the table that there is the biggest buffer we have ever had between growth and recession, and that comes from both the household balance sheet as well as the corporate balance sheet. They are in the best shapes that we've seen since the 1970s, or as far back as data like this via, if you go to websites like St. Louis Fed, right? Household disposable income versus obligations. Like that's at the best level since the data began in the 1970s. That's the cushion. That's why the Fed believes they can continue to hike rates to achieve their mandate, fighting inflation, because they know they have this battle buddy, That's what I've been calling, this kind of data. It's the battle buddy. It tells the Fed they can keep going. They need to monitor, household, balances, corporate balances, as well as all kinds of other metrics. But this is their battle buddy. It gives them an idea of whether they're going too far or haven't gone far enough yet. Has it come down from this ridiculous peak? Absolutely. Again, there's going to always be some mean reversion you've got to be aware of, but the absolute level is ridiculous. When I say ridiculous, we're 3 times the best level pre-pandemic. Any period, we are 3 times higher. Why haven't we found ourselves in a recession? It's one of the biggest reasons. Remember, all housing transactions are going down, new home sales, pending home sales, right? Existing home sales, they're all going down. And usually housing leads the economy. We're not a couple months into this, housing transition, housing normalization, housing mean reversion, negative transactions. We're 9 months into it. We haven't actually had a recession yet. There's got to be a reason. And I'm telling you, it all starts with jobs. It manifests in household, in corporate balance sheets, and it goes from there. Never before have you been able to, see the magnitude of these transactional declines, right? Because they're double digits on a month-over-month basis and not found a recession. We've had year-over-year declines, right? 2018 rings a bell. Right? It was a year-long decline in the year-over-year data, but it wasn't double digits. We're getting double digits now on a month-over-month basis. And yet, consumer spending is still very strong. Job growth is still very strong. Retail sales are basically near record levels. That's not a recession. It's just not. And the household balance sheets have a lot to say about that. All right. Kind of wrapping things up here, and I don't know how long we've been going, but again, I hope our audience and I hope our members get an opportunity to watch this kind of a recap and the offering of additional context here in this video, and we'll see if we can continue it going forward. The finish line is near. This is how we're kind of wrapping up our weekend research report. This data here, and we've shown it in different forms. But this is 1 year after the midterm elections. The market has never been lower. So come November 2nd, because that's the midterm election day, come November 2nd, where's the S&P 500? You need to know, because 1 year later, going back to 1950, the market has never been lower. It doesn't mean it can't be lower intra-year, but it won't be lower on November 2nd of 2022, come November 2nd on 2023. And why is that relevant? Again, if we eclipse the June lows in between now and then, you're getting opportunity, so says history. Was there not inflation in the 1970s? Was there not inflation in the 1980s? Was there not various periods of the Fed hiking rates during these timeframes? Of course, and yet still, the market was always higher 1 year after the midterm elections. So let's narrow the time frame, right? Because that's a big, that's 12 months. That's 12 months we're talking about. Anything can happen within that 12-month period. So let's look at midterm seasonality, S&P 500 from the midterms, November, to the next year in April, right? The best time to own stocks. The best time to own stocks is that 6-month period. But this, we're just looking at the midterm years, going all the way back to 1942. 1950, I raise you. We're going back to 1942, just November through April. The market has never been down. Never delivered a negative return from that midterm election date to April. The worst return was 0.7% in 1946. Everything else is 4% or better. The average is 17.2%. batting 1,000, never been down. So that kind of erases the, yeah, that's a long time set. 12 months, anything can happen before we actually get, above the midterm election day S&P 500 level. That eliminates, this data eliminates that concern. Again, it's another 100% positivity rate, folks. What else? Does the market like a gridlock? Right, because right now it does look like the Republicans are going to pick up a goodly, possibly 30 to 40 seats in the House and recapture the majority. So you would have a divided government, and the market loves divided government. The market loves divided government. It doesn't like uniformity. It doesn't like uniformity. The worst uniformity of government, and this is just the data, folks, I'm not making a political statement, it's what the data says. The worst form, worse, not worst, but worse, has been under Republican regime. So it just is what it is. Returns in the third, because next year's the third year of a presidential cycle. Like, we've been talking about this again since the first quarter of the year. Returns in the third year, going all the way back to 1927. We got the cutoff here at 2007, but I did the additional research to, take it forward. So going from 1927 to the present day, so we're looking at just the third year of a 4-year presidential cycle, the market has only been down once. The other time it was flat was 2015. So the question you ask yourself is, do you lean into this probability, or do you lean into all these probabilities? Plus this, right? And people say, well, anything can, I don't care. I should not be investing with anything can happen and history doesn't always repeat. It's not about history repeating. Your job as an investor is to lean into the highest probability. You're not taking low probability trades, are you? You're not taking the least probable and profitable investments, are you? No, it's about the probabilities. You want to lean into the higher probabilities. Do they always pan out, right? What if it's 90% probable? Again, you lean into that, but there is a 10% chance it won't work this time. I guarantee over the course of your career, if you lean into the greatest probable outcome, you'll do better than you would otherwise. I think that's a good wrap here. So I hope you enjoyed this kind of live version and recap, offering greater context of what our members, our premium members, and what our contributing members get to consider on a weekly basis. We deliver it every Sunday. Well, I should say 3 Sundays a month. I need my time off as well, but we also do a weekly state of the market every week, which is delivered Thursday. So with that, I'm Seth Golden. I hope you enjoyed this and have a great trading week.